Alright guys, so in this video I want to cover how to and what it means to dollar cost average in. So when you DCA, that means you're going to buy in at different prices. It can be that you're going to buy in every day, you're going to put $10 in every day. It could be you're going to put $100 in a week, $100 a month, $10,000 a month. Whatever it is, you're going to set up a dollar cost average into the market. When I talk about DCAing, I'm talking about a significant drop in the markets. Okay, so when you're talking about crypto, a normal day in crypto, markets can jump up or down anywhere from 5 to 20% in a single day. That's just a normal every day in the crypto markets. So any kind of change up or down 5 to 20%, I'm not dollar cost averaging in. When I see a 30 to 40% drop in the markets, I'll start to dollar cost average in. So if we look at XRP for as an example, right? We take the measuring tool and we come up here to the peak of the market, right? Because let's say we're in this range here, right? We're not. This is where we are today, but let's just say this is where we are, and we start right here at the peak, and we have dropped 7.37%, 7%. That's a normal everyday thing in crypto. So I would not dollar cost average in. Next thing you know, we come down here to this day and we've now dropped 28%. I still would not have dollar cost average in because that's normal and we are not at that 30 to 40%. Here, when we dip down to here, we are at 45%. I would have dollar cost averaged in, and then when we reflected back up and came back up here, I would have probably got back out of that trade. Okay, but this is where when we hit that 30%, which is right here, to 40% range, that's when I dollar cost average in. Okay, so let's do it like this. Let's say we came in here and it hit 30% right here on that white line. Okay, that white line right there. Let's say that's where we dollar cost averaged in, right on that white line. Now what I'm going to do is wait for another 30% drop from this top. So 60%, right? 30 plus 30 is 60. So now I would wait till markets hit 60%. So at this point, even where we are right now, I would not dollar cost average back in until we hit that 60%, which is right there. Okay, at $1.34. So when I talk about dollar cost averaging in, what I've been doing for the many years is we ride these 4-year cycles where we go up and then back down in 4 years. We go up and we come back down, and then we have this 12 to 15-year cycle of recessions, boom bust cycles. Okay, so in these 4-year cycles, you're waiting until we have that crash moment, and then you're going to start dollar cost averaging in. You can choose 30%, 40%, 50%. You have to make your own decision. Let's say you choose 30%. Every time the market falls 30% from its peak, you're going to dollar cost average in. That means you're going to dollar cost average 30% down from the peak, 60% down from the peak, and 90% down from the peak. That means 3 different times you're going to dollar cost average in. And that's going to bring your average price that you paid down to about somewhere in the middle between the peak and where the price is currently at. And when we rebound out of these markets, we always go back to where it originally was, so that would be back up to here and then up higher. That's just how markets work in these 4-year cycles, 12-year, and the 12 to 15-year cycles. Okay? If you listen to people like Eric Trump, who told you to get into ETH way back up here when we had this drop, right? Does it fall within our rules? So the peak is right here, right? There's the peak. That's a double top, by the way, so that's telling you you're fixing a drop. So if we would have got in where he said, which is right in here somewhere, that's only 20%. We never hit that 30%. If we got down to here, we're still at 24%. If we got down to this one, we're at 28%. We're still not dollar cost averaging in. So the first time we would have ever dollar cost average in would be on this candle right here, right? And then at the 60% mark, which is where we are right now. So you would have dollar cost averaged in twice at this point into the markets. Okay? And then if you wanted to dollar cost average in at 90% drop from where we are right now, then you would have to be all the way down here. There's the double peak. 90% would be at $394 basically. Or yeah, 394. Okay? So if you're just now getting started into crypto and you're just getting involved, you're just now beginning to invest your money, you're at a good place, right? We're at 60% drop as far as Ethereum. BTC, another double top. We're down currently 29%. So at this point, if it was BTC, I would consider getting in. It's 29. We're not at 30%, but right here where it actually bounced down to, that is 31, almost 32%. So I would have dollar cost average in there. So what people like Eric Trump are getting people to do is if the markets drop 5 to 10%, he's saying, well, this is a good time to DCA in. And that's the mentality of most people that DCA. But the problem is when these markets on a daily basis can move 5 to 20% on a daily basis. So dollar cost averaging in every 5% drop or every 10% drop or even every 20% drop is foolishness. What you're looking for is significant drops. 30%, 40%, or 50%. You choose which one to use. Me, I like 40% because that gives me 40% drop, 80% drop, which in crypto, during recessions, you drop 80 to 90%. So if I'm doing 40%, then I'm going to catch it at 40% and then again at 80%. And by then, we're pretty much at the bottom, right? And then I can kind of DCA in as it flatlines because when you get to the bottom of a market, let's go over here to BTC for a second. I want to show you this, okay? Here was the last bull run. You go up, come down, go up. That's the normal bull run, right? Here you've gone up, come down, gone up. Same cycle, right? So what's going to happen is you go up, you come down, you go up, you're at the peak of the markets, and then you fall down, and then you kind of level off right here. And if you notice for BTC, that range is 36% range in that right there where it leveled off. When it's leveling off, when you start to go sideways like that, that's when you really want to focus because that's when you're getting ready to take off for the next bull run. All right? When we're doing these drops like we're doing right now, right? And who knows where this is going to go? It could go all the way down into the 40K range. If we could come all the way back down here to where all this buying and selling was taking place all the way across and end up all the way down at 48%. Nobody knows where we're going to fall to. Nobody has any idea. All you can do is dollar cost average in, and if you stick with your plan, 30%, 40%, or 50%, that means you're only going to dollar cost average in 2 or 3 times maximum, and you never run out of capital. 40% plus times 3 is 120%. If you buy in after a significant drop of 40% or more percent in the market, you are now in the market 40% down from where it was. If it drops another 40+% and you DCA in some more, the market is down 80% from where it started. So you only DCA'd in twice. And if it drops another 40%, the investment is 120% down from where it started, meaning it is at $0 or zero value. And you clearly did not do your research on the investment as you chose a worthless investment if it goes to zero, right? So you can't run out of capital if you DCA in properly. 40%, 80%, you're done DCAing. Now, if it hits 90% or even 95%, sure, yeah, of course, put some money in because you're at the very bottom of the bottom of the bottom of the bottom. But the point of the matter is You pick it. Are you going to wait 30% from highs, or are you going to wait 40% or 50%? And then you just DCA in on those targets. If it doesn't make it to your target, say it drops 40%, you DCA in, and now you're sitting there waiting for it to get to 80% and it never makes it there, well, then you're at no loss, because eventually it's going to come back up to your 40% and then on beyond, because it will always go back to where it was. See, here was the peak of this cycle. It came all the way down here, which was basically a 77, 78% drop, and then it came back up to that peak and beyond. That's what the markets do in these cycles that they have created in order to create boom and bust cycles, right? Printing of money, withdrawing that money, pulling it out of everyone's bank account, making themselves wealthy, and basically robbing the poor. That's how it's always been. Now, these cycles are coming to an end, and we are at the end of these 4-year and 12 to 15-year cycles. But my point of this video is to teach you guys how to DCA in. You pick your target, 30%, 40%, or 50%. If you choose 50%, that means it has to drop 50% from the highs before you're going to DCA in, and then that's your only DCA, because the next 50% is 100% loss, right? Which means the market has gone to zero. And it's the same thing with stocks. Now, stocks, on the other hand, if we go to swing traded and we go to these stocks, right? These don't drop 70% and 80%. They don't take 5 to 20% swings in a day, except when there's extremely good news. But let's just take Google, for example, and we look at Google. It's the same thing. 4-year cycles. We go up, we come down with the crash. We go up, we come down with the crash. We go up, we come down with the crash. 4-year cycles, right? So you have basically from the bottom here, 2020, to the next bottom, basically in the 2023, 2022, right? 2 years. But if you look at these markets, they go up, they come down, they go up, they come down, they go up, they come down. But in general, it's uphill, right? It's uphill. But it's these cycles that they draw everybody through in order to steal wealth. Okay. Now, when we look at these markets and we look at what's happening here, you see a 40% drop. So if you chose 30 or 40%, well, you'd be getting in right about the bottom, right? There's 40%. And then it would come back up to where the peak is, and then continue up. That's just how the markets work, guys. All you have to do is use wisdom. Have an understanding of these cycles, and understand that we are coming to the end of these cycles, and now is the time to be dollar cost averaging in, because we are about to go into a super cycle and an extremely booming economy like the United States has never seen before. So use wisdom, pick your spots, 30%, if it's crypto, 30%, 40%, or 50%. Do your DCAing in. If it's stocks, well, we can see on stocks that, let me get zoomed in here, that we do not swing 15 to 20% per day. Right? Let's find a big candle. Here's a big candle right here. So in one day, let's take our measuring tool. In one day, from the peak of this candle right here to the bottom of that candle, we've moved 4% in a day. Right? It's not like crypto where you can move 5 to 20% in a single candle in a single day. So with stock markets, I'm looking for 20% to 30% to DCA in. Crypto has massive swings on a daily basis for now, until we get regulations in place. Stock market's regulated, and stock market does not have this volatility that crypto currently has. So in stock market, I'm looking for a 20% drop in the markets. A 20% drop is significant. In like I said, from the high right here, let's bring this down a little bit. From the high right here to the low right here, is a 23% drop. That's where I would be DCAing in, right at 20%. Let's look at right here, where we're at currently. So right now, with at least with Google, there's the top, and we are currently right there where the red dotted line is, 29%. So at the 20% mark, which would be right here, I would have DCA'd in. And if it gets to a 40% drop, which we'd have to bring this down to look at it, if it gets to a 40% drop, that would put us at 40% right here. At $124, I would be DCAing in again. And then if it dropped another 20%, which would be 60, which would put it down below, well, below 80. Here, let's just take a look. %60 would be 81. So $81, I would be DCAing it again. And all you're doing is you're bringing all you're doing is averaging your cost to a higher position, because no matter what, when the markets come back, they always go back to the original peak and then higher. Okay? But this is going to be a super cycle, something that we've never seen in the history of the United States. Plus, we're going to have tariffs that are going to be paying down the national debt and all these other different things. So hang in there, guys, and understand how to DCA. Pick your spot: 30%, 40%, 50% for crypto. In stock markets, 20 to 30%. That's where you're going to DCA in. So that's it. That's how easy it is. And then when things finally take off, you're in position to make your family a lot of money. It's very simple stuff. And then remember to DCA your way back out when you have significant returns. Peace to you all, and I love you guys. We'll catch you guys in the next video.